Okay, I'm gonna try and do this kind of like ultimate thought process guide overview to bull market conditions. And when I'm referring to like the bull market in this context, it's slightly different to just an uptrend because when we have what I'm referring to as kind of bull market conditions, the aggression and the volatility is notched up. And so we tend to see greater returns in a shorter period of time. It's kind of acceleration mode for the trend. So there's a number of things that you can see on screen, and they're kind of like topics for myself to dive into individually. There's kind of a chain to them. And then I want to have a bit of a discussion around the leverage utilization during strong trends. So I'm going to try and cram as much as I can in here from my history of past cycles, what I've learned, and hopefully what can go towards assisting you. So the first thing that we'll start off with lowering your IQ. This is so important from a bull market perspective, and it has a knock-on effect in all of these other sections that I'm going to kind of cover off, which is, timing expectations, euphoria, fudding yourself, and becoming contrarian. Lowering your IQ is the base of what it takes to be a good bull. There are numerous people who, in the last bull market, essentially just bull posted constantly. Just constantly bull posted every dip, just buy it. And they did exceptionally well. They were some of the kind of standout performers of the last cycle. And it's not necessarily because their decisions are inherently dumb. It's just because it's a trust in the trend. It's a blind acceptance that the trend will continue higher. The conditions are good, and therefore, whenever we are presented with opportunity like dips, it's something that you should be taking on board. The problem with kind of the bull market cycle for a lot of people, and this is something I cover in a lot of educational material, is that knowledge is actually a curse when it comes to trading, and especially when it comes to trading strong trending conditions. Because the more information we have, the more kind of signals we're using, the more technical analysis that we're diving into, the harder it becomes to make decisions. Because in strong trends, technical analysis doesn't really make sense in the same way. We can't really use the same indications that we use in the nice either calm trending markets or in the ranging markets. It simply doesn't apply to the same degree. So the whole absorbing as much knowledge as we can essentially kind of curses us with this paralysis in our ability to be able to action and execute on the market. So we really want to lower our IQ. Technical analysis, when we're in an acceleration phase of a trend, does not matter. Okay, there are some helpful instances. Today is probably one of those. I'm recording this video where we tapped all-time high on BTC. We just had a very strong sell-off kind of on the after achieving that, and alts got hit particularly hard. We've seen some alts doing kind of minus 30%. We've seen minus 50% over the last couple of days. TA can be quite helpful in determining levels on the downside that may be of interest. Where TA usually fails is providing the nice, safe entries to the existing trend. So when we've got something that's just kind of nicely going up day after day and you find yourself sidelined, that's usually because you're relying on the TA aspect in order to find an entry, and the TA just isn't working in the current kind of phase of the cycle. And that kind of just goes hand in hand. That's what happens. Okay, the signals that previously felt great aren't so good anymore. The TA is usually actually telling you the opposite thing because it's making it harder to find an entry because things look overextended. Things look like you can't possibly pull the trigger on them because we've just gone up too much too quickly. And it kind of gets in the way. So I don't want you to completely throw out TA. I don't want you to be like, he's just saying get rid of everything. I'm not. I just mean if you're somebody who struggles to find entry into the market and you're relying on the charts to do so, that's probably an issue. That's probably one of the causes of the issues that you're having in actually taking advantage of the conditions. The people who kind of do this best are those people who, and there's a very important topic missing here, which I'm just going to stick in now. Those who simply buy. They simply buy and that's it. And that kind of relates a little bit to the point down here, okay, about leverage being the devil. And I've just left this up as a constant warning and a discussion point that we'll have later. But if you just buy a market and you are prepared to accept the potential for a drawdown like we've seen today, and you manage your risk appropriately to account for that, you keep capital in reserve in order to buy in opportunities in which we see substantial sell-offs in the market, it's essentially just a far simpler and easier approach than trying to map out with TA, levels, indicators, where you want to be a bidder, etc. Now, not everybody will agree with that summary, but for me and for most market participants, the easiest thing to do is to manage your risk around entry, your thoughts around downside, and simply play it because the market is uptrending. Right, so that's kind of the lowering your IQ topic. And maybe we mark these off slightly to say we're done with this one. Let's just do it like this, right? To say we're done here. Okay. Timing. What I just came onto at the end of that then was about just buying and holding, basically. That simple approach to buying and holding. What it comes down to is really your time expectations for the market. Okay, so the timing aspect of things is important, and the timing will also link us down here shortly in terms of what we want to look at from this drawing. Your time expectations are very important. If something draws down 30%, but you have expectations of holding it for the next 6 months, that's a bump in the road to you. That's a pain. That's annoying to see in terms of your portfolio that it's taken a dip down. But if your time expectations and horizons are 6 months plus, 12 months plus, you want to just keep riding the trend, you're going to get these bumps along the way. You're going to get these moves down in the market which are going to impact you. It doesn't mean that you now need to alter your entire plan. Having a very fixed and kind of understandable time horizon for what your investment is looking to achieve is super important. On crypto Twitter, we have this huge tendency to be in and out of positions very quickly, always looking for the next thing, swapping between different kind of market areas in terms of the rotation plays that we're looking for. And really, it's just kind of detrimental to us. It kind of clutters the mind with all of this stuff, and we become very short-term focused. We start to focus on things. If they're not pumping in the next day, then something's wrong with that market. And why would you be in that market if another market is up 30% in the same time period? So we start to lose ourselves in this short-term mindset about kind of what we are trying to achieve. That is kind of a haunting thing for a lot of people from prior cycles. The never-ending rotation while maximizing on nothing. Previously, and not long ago, I started the sideline portfolio project in the Haven, which was to give people an idea of what it looks like to just buy into a market. Just taking entry in an uptrending market, understanding that time horizons are pretty decent for those spot buys, some small use of leverage in there, and then letting the positions play out. Now, I chose what you would probably classify as underperforming markets. I haven't chosen the hot markets. I've chosen markets that had very simple entry criteria, and I took them. And those markets are all performing very well. What we tend to do is we tend to focus on the underperformance versus the hot markets debate. Markets at the moment like Pepe and WIF that are moving 40% a day, 30% a day. And all of a sudden, our entire energy becomes consumed by those markets. And we forget the other markets that may have simple criteria for entry. They might just be something that is just a simple support and resistance play, and it's sat there, and you can just take it, invest some money in it, and you might be up. Now, the problem with that is that you start to look at the market and you say, well, I can't touch Matic, for example, because Matic is an underperforming market, and I'm only going to get 25, 30, 35% returns if I invest in Matic. But if I look at Pepe, I might get 150% returns if I invest in Pepe. The mind is very good at making us kind of think about the hot things, think about the positive outcomes from our actions. And actually, what usually takes place in those scenarios is the person who has that thought process ends up fucking about with either leverage or positioning on something like Pepe. They spend 3 or 4 days doing so, getting chopped up back and forth in lower time frame volatility. And they come out of that market having actually lost money and not gained anything. Now, in the meanwhile, Matic may have moved 25% from what would have been a simple entry trigger for you and would have netted really good returns over the same period of time. Now, the process there is not to say divert all of your attention to the lagging markets. It's there to say that not everybody is suited to being able to time the rotations or to be able to appropriately enter into the hot markets. And while we consider underperforming markets, while we consider markets that have not yielded the same returns over the last 12 months as other markets, they're all absolutely fine markets to still make money on. Underperformance shouldn't be marked market versus market. Underperformance should be marked against your own personal performance. If you're somebody who's performed very poorly in uptrending conditions, likelihood is that you're probably trying to jump around too much. You're trying to use too much TA. You're over leveraged. You're trying to catch all these big moves. You're trying to size up into them. And in fact, just the simplification process of just taking entry in something that, yes, may not be one of the hot markets that the whole of Twitter is talking about, but could yield you a really easy return on your money is well worth a consideration. So we kind of got into a couple of things there on the back of timing, but I want to stress, hot markets are great, but your benchmark should be your own personal performance. If you can't stick anything to watch these hot markets actually take off, your approach is wrong. You should be instead focused on other things that are a little bit more simple and easy to manage and easy to take hold of. And then remember your time expectations. That's where we started on this whole kind of discussion that I've just been on now for the last 5 minutes. But your time expectations are super important. Understanding drawdown, understanding risk, all revolves around your time expectations and what that actually looks like when you consider the longer term. Now, if you're somebody who's a scalper, that's going to be very different to somebody who's looking at swing trading and holding over the course of 2024. But the timing element's super, super important to have a hold of. I like blended like 8 things into that, but there we go. Expectations. Good topic. Expectations. Now, our expectations are usually blown out by bull markets. They're usually blown out to the upside by bull markets. Things usually perform to a far greater degree than we imagine that they will perform. Now, there comes a point where our expectations take over too much. So the last time that BTC was trading up at the 60,000s, there were lots of calls for 100,000, which didn't quite materialize. So there comes a point where our expectations start to potentially get out of line in terms of what we're seeing with the actual development of the market. But as a very kind of simple rule, you should always try and expect more to the upside than you kind of set your sights on. A common one at the moment is Doge going to $1. I probably think that Doge actually trades significantly higher than $1 if we get the continuation of the bull market kind of environment. I think that actually that is a target that's on the lower side of where we should be pitching for something like Doge. So we need to balance our expectations. The only way that we can kind of achieve that true value from a bull market is by having the balance between making sure our expectations are set high enough and also managing to take profit on something. That is a really hard balance to get. Now, I don't have the easy answer for you on what that looks like. I don't have the easy answer for where taking profit is and where it should be for you, or what level your expectations should be set at. All I can do is give you a very easy blanket approach of your expectations should be set relatively high. You should try and push the market when it's in these conditions for all you can. But then there comes a point where you have to appreciate the fact that you've either made a lot of money or that you believe that the market is tiring under whatever premise of system you have, and make a decision on taking profit. That's enough on expectations. It's only a loose one. So then we get into kind of these feelings, and these are all part and parcel of kind of the same process and something that is super important. And this is something that actually has come up in discussion quite a lot on Twitter over the last week or so. We have euphoria, fudding yourself, and stopping yourself becoming a contrarian. And these kind of link. This links into this, right? This is going to link into this. You know, there's all sorts of different links here between these last three. We'll start off with euphoria. Now, euphoria is a phrase that we've been using quite a bit recently, and it's something that actually is like, it's important to understand the context of what euphoria actually is. Now, I tweeted the other day to say that euphoria isn't the fact that a niche community online is discussing how happy they are with the returns from the last 3 weeks. That's not euphoria. Okay, that's a part of what euphoria can be. But this is still a small community that is discussing what gains have been made in various assets across the last 3 weeks. It's important to understand. Now, when you spend all day on crypto Twitter, and maybe that's like slightly overkill for a lot of you, but when you engage in Twitter a lot, and when you're present a lot, and when you're absorbing all of this information, it can feel as though everybody is in this state of absolute bliss, and therefore there's a concern that the market is topping out. Not necessarily true. Hey, again, this is a small community. Now, if you consider where we were in the last bull run, if you consider the fact we had huge brands engaging in NFTs, we had mainstream media headlines, we had normies who knew the price of every asset that you could name. You had people that were pulling up their Robinhood apps and creating TikTok videos of what the balance was yesterday and what the balance is today. That is far more in line when we have a global euphoria versus what we have in a very isolated, community-based, social media, Twitter-led patch of happiness. So the reason this is here is because it is here to say, don't fudge yourself out of positions just because you see happiness on the feed. Just because you see happiness in the timeline and you see people excited about their profits and enjoying the market currently does not mean that you now suddenly have to mass close all of your positions because everybody is having such a good time. It's a bull market. We're supposed to be having a good time. Right? The markets are up. So don't start fudding yourself out of your own positions and your own line of thought and your own expectations and your own time in terms of how long you want to be holding positions for, just because of this. Apologies, I just got a drink because this video has gone far longer than I imagined it would. Okay, so that's a quick discussion on euphoria and fudding yourself. And actually, I'll cover off a little bit more to fudding yourself here, because the fudding yourself here also links into here and is super important. So there'll come a time where usually your expectations have been achieved or more, usually more. And then what happens is you, instead of thinking, oh shit, Twitter is super happy, you start thinking, holy shit, I am super happy. And if I'm getting this right and I'm making so much money, this must be a sign that things are getting ready to top. So what actually happens in kind of a pricing dynamic is, I can use this down here. As price climbs higher, you would think that it's all just easy for us. You would think that it's just all one-way traffic, not a problem. This is easy. Like the price of my assets are going up. what actually happens at the same time is our levels of nervousness also usually follow a similar path. So as prices get higher, our levels of nervousness start to creep up, which is where we start to engage in this kind of fudding yourself process. And what this usually results in is kind of the paper hand complex, where you drop things early because you think, oh shit, like this has gone up a ton now, and I think there's probably a good chance this is the top. I've seen some tweets about it. It's making me nervous, and everything starts to kind of cycle in, and you end up closing the position. And then usually in those scenarios, what happens is the price just continues going higher because the trend is all that's important, not your emotion that's associated with it. And therefore the nervousness element really, kind of shouldn't play a part in it. And like I said, there's lots of links in here. It might be the sense of euphoria that you have with the position. But appreciate the fact that nervousness does rise with price increases because it feels too good to be true at times. Okay, it feels as though the market shouldn't be giving you these returns. Like how could you have just made like 2x your money on whiff in 24 hours? Like what's going on? Like that's got to be a sign of a top, right? So you've got to remember to like kind of understand this and this in that your expectations should be set high. Prices going up aren't a reason to believe that you should be out of the market. The more regularly you do that, especially in bullish conditions, the more likely you are to be giving back profit to the market, or at least not taking full advantage of what you could take from the market in terms of where we actually ascend to. And then you've got this last one here, stopping yourself becoming contrarian. Now this comes with this, And what this is, and I can use this example here of price climbing again, is this is the situation where you felt euphoric. You might have closed your position down. You might have fudded yourself, which aided in the decision making to close that position down. And because of all of these things, you now start to think that the market is worth shorting. You now starting to believe that this market is overcooked. You think that this market is done. This happens for two primary reasons. Number one, because you felt so good in the trend and you believe that you shouldn't have felt that good, therefore something's wrong in the market. The other time that this happens is because Twitter is having a very good time and people who you consider as novices or idiots are making money. So normies making money. People that you consider like morons and complete plebs are also making money. Now, usually this situation is also because you have closed down a position, but other people are now still making money. So for example, whiff is a good one recently. You close down, 30% move to the upside. You think you're happy with that. Market continues to rip. It does a 5x in the next week. And you cannot wrap your head around the fact that other people are making money. And this shitcoin, I like whiff a lot, by the way. I'm just using the term. This shitcoin is ripping. And all of these people who have no financial information whatsoever, all of these people that have no idea about the detailed levels of technical analysis that you complete on a daily basis are making more money than you are. And for you, that is now a problem with the market. And because that situation has developed, you now believe that this market must be getting close to topping out. And so you start to become a contrarian to the trend. Your mindset starts to shift and you think, nah, it's not right. You can't be making that much money. How is this happening? And before you know it, you're trying to short the market. Before you know it, you're pissed off at the market. You're revenge trading the market. And you're in a situation where you've now lost all sense of all of the prior points. And you've just become this aggressive market participant who cannot get back on the right side of the trend. So these are all really, really important points for the psychology that's associated with the bull market. And I'm kind of taking it through step by step. And for a lot of you, this will be the first time maybe that you're hearing me talk about the psychology side of the trading experience. And this is something I focus on a lot. This is what the foundation is built entirely on. I can plug that now. If you're interested in more information like this, building portfolios, risk management, then please take a look at the foundation link on Twitter, which is a great course and structure for getting involved in very strong uptrending conditions. But all of this stuff here is all to do with the psychology of the trend. And it is by far the most important thing that you can acknowledge during a bull market. The money in a bull market is made from the right psychological balance, not from TA and diving into massive amounts of detail in terms of what's actually transpiring in the market. It comes from your own risk management discipline, execution ability in order to do that. And so I hope that kind of covering a lot of this stuff, you can maybe see some of the things that you've done in either in prior cycles or you've started to do in this one, and that it can change your viewpoint and your way of acknowledging these things should you start to see them develop in yourself again. I would urge everybody to kind of make notes on how they're feeling, because that can be a really important moment in actually identifying, look, I'm actually really pissed off with the market currently. Like I'm in kind of the disbelief phase where I don't really understand how people are making money here. You know, how are these idiots doing this? Okay, so you want to be able to make sure that you have a note of that. Then the last thing I want to cover is this point down the bottom here about leverage being the devil. And it's not necessarily true. It's just the way that I'm framing it for this. Leverage has a purpose. And you'll see lots of people talk about leverage during uptrending conditions, and they'll slate leverage and they'll tell you not to use it, and that can dishearten a lot of people because a lot of people rely on leverage because they feel as though it helps them to size up into positions, or at least it fuels the dream that they'll be able to spin a smaller amount of money into a larger amount of money with the help of some leverage. So I'll give you my personal take on the way that this works in uptrending conditions and the way that I find is the best leverage utilization process that you can kind of try and engage with. And I can finally use this beautifully drawn chart for something other than the kind of the emotion and the nervousness correlation. So let's imagine that this is a chart of price action. And you can obviously very clearly see the two major dips that I've put in here. One of the other things that you'll hear about a lot during the trending market is you'll hear about funding rates a lot. And you'll hear about leverage flush outs, you hear about funding resets, you'll hear about these different terms that basically are people asking the market to deliver some downside, to wipe out longs, to reset the balance and allow things to continue back to the upside. And we see several of them each bull run, some of them more violent than others. This is a good kind of map out of the way that they tend to look, right? And tend to being a very general term. When we're considering our leverage use, we have a nice correlation here, and we have a nice thought process through this journey. As price is increasing, and let's imagine that we're flat here. So let's change this as well to this. So let's imagine that we're flat. We don't have a position, okay? As price increases without any pullback or flush out, our leverage use has to decrease, okay? Price is trading higher and higher. And if we imagine we've got both time and date here, time and price action, and we're like this, okay, the further we get, the less leverage that we can use. So if it has now been 2 weeks since we had a leverage flush, we cannot start jacking up to high leverage. We cannot start increasing leverage. Now, you may have guessed from that nice little intro that I've given here, the best opportunity we have for using leverage is down here. Now, it's not to say we need to knife catch. Okay, it's not to say you need to be catching the Pico bottom and you need to catch the 20% wicks to the downside. It's not that at all. What this is to say, riding back up here, we can still utilize leverage. Okay, we can still use leverage through these regions. It's fresh. There's been a leverage wipeout. The deck has been shuffled, and we're good to go again. So we can start thinking about leverage use. So this doesn't mean you want to be slamming on 50x, 100x, but it does mean that the opportunity is there to now try and engage with the leverage system again. We've seen the flush out. We've seen the very strong pullbacks in the market, and we're now presented potentially with the opportunity in order to try and add some leverage back to our positions. And once again, if we're now looking at the market and we're now up here and we're looking for an entry, our leverage has to decrease again. If we start off here and we say, okay, well, actually, we fully recovered and I expect the trend to continue. Let's just use 20x as the example. Again, I wouldn't suggest that you should be using that. This is just the example. Now, the further that we get up towards here, right, we have to start thinking about, well, if I want to enter a fresh position now and we're here, then I can only use 3x leverage in this scenario. Because I'm now aware of the fact that we have not had a leverage flush out again in the last 2 weeks. It would be unwise of me to open up the 20x position because I'm at risk. And instead, I'm going to take a smaller position size. I'm going to manage my risk a little bit better through this region as well. And then action it like that. Okay, so the best opportunity we have in terms of leverage usage in strong trending conditions is after flush out events that have ripped through other participants who are over leveraged and now present us with the opportunity to use leverage. And the same logic applies when we're thinking about taking profit on positions or when we should be taking profit on positions. If you just take that example of what I've drawn down here, and we just do exactly the same thing, you think, well, I'm sidelined here. Sideline, 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 sideline. I want to take position in the market now. Whatever signal has been achieved for you, whatever reason, whatever, the FOMO finally hits, I want to take position now. Once again, we need to be aware of the fact there has been no leverage flush out in a good length of time. And the more that price increases without one of these flush outs, the closer we fly to the sun. And we need to think more aggressively or readily about taking profit. Now, if we're building positions, if we're looking at doing things slowly, we're building spot, then that's really going to come back down into this point here. Because if our time expectation is actually over the next 6 months, so this doesn't matter to us, then that's fine. If we just want to take a starter position, we want to take 20% of a position, then that's fine. If we want to go 100% and try and trade this market, then we have to be aware the more time that elapses without a flush out in the market and funding rates increasing, warning sign for how long we can hold a position for. Otherwise, you get caught on something like this and you either round trip the trade, you get liquidated, or you get slipped heavily on a stop. That's the way that things are going to work for you. And then the final thing that I'll leave you on, after the leverage discussion, the final thing that I'll note here is, if you ask the majority of traders who have experienced previous bull runs what they would do differently, I can assure you that a 90%, 95%, maybe more, one of their points that they would have would be to hold spot and to not trade leverage. Now, there are some people who have done very well trading leverage. For the majority of people, they wish they just held through a bull run. If they look back at what they did on prior bull cycles, they wish that they just held on to their spot and they didn't get involved with trying to trade on leverage and trying to jack everything to, crazy totals. I think take profit would probably be up there as well. But just think about that when it comes to your positioning. You have an amazing opportunity. You have the ability to try and change your financial situation through the actions that you take during bull market conditions in crypto. You cannot do that if you are super aggressive with leverage, if you have no appreciation that you cannot do that in a week, that you need time. In order to have time, you need to be surviving. If you're constantly pissing away money, taking stupid trades, using too much leverage, having no appreciation for the conditions, you're going to waste this opportunity. For some of you, this will be your second, your third cycle. It's so important you grasp that key concept that spot utilization, realistic time horizons are going to be absolutely key to you driving and growing a portfolio. And like I said, there are some opportunities for leverage, and I have no problem with people who want to use a little bit of extra juice for their spot buys. You need to have a process in place in order to be able to capitalize on this. All right. So I hope this has been helpful in kind of diving into the mindset of what can happen during strong market conditions and the way that we can think about leverage uses, the way that we can think about positioning. And if you want to hear more from me, if you'd like more educational content from me, like I said, you've got the Foundation, which is a standalone course, which will be super helpful to you in this run. And you've got the Haven if you want to see all things education plus portfolio deep dive. Thank you very much for listening, and good luck.